Well, good morning. I have tried putting this video up several times, but I just can't seem to get Vimeo to record the screen for more than 15 seconds. So I'm going to try it again with a different system. This will be my last market outlook from Canada because my flight leaves I'll be leaving here in a couple hours to head to Toronto for my flight. And I couldn't get it up Sunday, and I thought, I'm not going to compete with the Super Bowl. And by the way, CBS did report that this Super Bowl was the most watched Super Bowl ever. Not because of the football, but it put it over the top because of Taylor Swift. What an impact, huh? If only she was publicly traded. Let's have a look at what we're doing here. Our money market rates, all well behaved over the past week. And I don't know that there's much excitement to be seen with rates anymore. I think the big excitement is over, and once the rate cutting starts, I don't know that that's going to be the bigger story. On the capital market curve, we are getting a bear steepener, but I think that's limited because we do have rate cuts ahead. And once we get to Fed funds futures, we'll see that they are so close together now. The FOMC at 3 rate cuts, the market at 4 rate cuts. I don't know that it's worth arbitraging that difference. So I don't know that there is much higher in yields that can be expected on the capital market yields. Volatility appears to be dropping. So I'm kind of willing to put rates. Certainly, they are in the passenger side in the vehicle right now. I'm kind of thinking of putting it more important. Slope still inverted to the 1031. That's 578 days. The the money market capital market curve, 127 basis points. I don't expect that to uninvert until rates actually start to get cut, because to have it uninvert, you would have to put the 10-year over 5.44, which is where the 3-month is sitting. It got to 5. And it looked like the bond market was falling apart. It got to 5. The Fed has now signaled rate cuts. January's C under. The balance sheet runoff, SOMA, unchanged. So we're still sitting at $7 trillion. Going to print a 6 because there are maturities on the 15th. 15th happens this week. Those will run off. So we will see a 6 next week. The Fed balance sheet itself up $1.1 billion. The bank term funding program down $369. The TGA up $43 billion. I don't know where this is going. Yellen had a target of $750 billion, and it's some $150 billion above that at this point. The reverse repo up as well, $56 billion up to $569 billion. The lowest still being $503 billion. And reserves are up as well, another $144 billion to $3.556 trillion. So I don't think you're going to get not balance sheet run. If you're not going to get a taper in quantitative tightening until the reverse repo is probably at 0 or very near 0, and we see reserves print a 2-handle, 2.9. Then I think the conversation will really start to get heated, because I think with inflation, with the way the economy has grown over the last, since 2019, over the last 5 years, it was estimated that about $2 trillion would have been the point where the reserves were considered ample, beyond the point of ample, enough to handle the fluctuations that happen on a weekly basis. That's probably for safety off. Money market fund assets up another $16 billion. Retail and institutional both joining the party here. Government up 6.3 for retail, down 2.57 for government, but both hitting up prime. Probabilities for March on doing nothing. Now sitting at 84%. Down up from 80% and 16% on one cut. Not very exciting there. June A lot of changes here. Two rate cuts, at least two rate cuts. Was 43.5 is now, was 55 down to 43. The probability for doing nothing, 7.8% up from 2.5, and one rate cut by June. That would either be the May meeting or the June meeting, 42% from 30%. And end of year, still just a touch, look, 0.2 on doing nothing. I don't think that's a reality. Let's look at where the market, where the Fed thinks they are. They think they're here with 3 rate cuts. Market is at 41.4, up from 34. So there's more probability moving towards convergence. For 4 rate cuts, went from 47% down to 32. So we are converging. The market seems to be converging with the Fed. One thing to keep in mind here, if you go back and look at the last 2 years, summary of economic projections, the FOMC has been wrong all the way through. They've been wrong on the way up, and there's no reason to believe that they're going to be right on the way down. They have been wrong. Now, that does not mean there'll be more than 3 rate cuts. I don't believe 3. They've been wrong all the way through. I just don't see why there's this belief that they're suddenly going to be right. Maybe it is not so much that the market has to converge to the Fed, but the Fed has to converge to the market, and the market probably or maybe had it right, especially when we'll see the revision to CPI shortly. Had that number printed and not the 0.3, we would have had a different market. We probably would have broke 500 on the S&P sooner, and TLT would probably be sitting around the high 90s, not the mid 90s. Monday, Bowman Kashkari. Well, Monday's in the history books because it is Tuesday morning. Tuesday, U.S. CPI. It's 7:05 a.m. here, and that's 1 hour and 35 minutes. 1 hour and 25 minutes. U.S. CPI. I'm sure from the time you're listening, it's either happened or it's very close to happening. Wednesday, Gouldsby, Barr, Bostic, and U.S. PPI. Thursday, we have Waller, U.S. retail sales. Friday, we have Barr and Daily. Real rates, the 20 and the 30 back over 2. The 10-year pushing up there 8 more basis points. It doesn't sound like a lot, but I can't see much more downside on TLT, which means not much more upside on yields. And the Fed Fund futures, we'll see in a second, I think are as tight as we're going to get it. That if there was a place to sell puts on TLT, I think it is at the $94 to $93 level. I think it's fairly well supported there, given that we do have rate cuts coming, given that we do have almost convergence between the market and the Fed. I'm not seeing much more room on the downside. So I don't know that you're going to actually see real rates across the 5 to the 10 breach the 2. But we do have an upward sloping real yield curve. Break-even rates, not much information here, not moving much. Here's the big change. June implied rate of 5%. We're at 5.33 on the effective federal funds rate. This is the implied effective federal funds rate, down 30 basis points, which looks like firmly one rate cut. September, another 36, and December another 35, for a total of 101 to the end of the year, from now to the end of December. 4 rate cuts. Fed is at 3. As I said earlier, I don't think that there's much value in arbitraging that. Now, we went from 100, almost 160, 158.3 basis points earlier in the year, down to 101. A drop of 50 some basis points. So if you did do something on Fed funds futures, whether you shorted the June contract or the December contract, the money's made. I don't see the value in holding any further. So I would not be short any Fed. 4 cuts is as close to 3 as I think you're going to get. You know, it's saying that the Fed is right and the market is wrong. Maybe the Fed is wrong and the market is right. In March, March, where is it, the date here? March 20th, in 38 days, we get new SEP. TLT did not have a good week, down 2.31%. SPY, week after week, look at this, week over week, 1.37%. Another all-time high. And it's based on the action on Monday. It just didn't seem to want to do very much. It tried, but there just doesn't seem to be a lot of enthusiasm to push it higher. The bulk of earnings season is done, but the multiple is increased again. We're going to see we're pushing up to 21 times forward earnings. Doesn't seem to be a lot of appetite to commit even more money at a market that is at a record. When you have interest rates at the money market rates at their cycle high, the market is at records. It just and you have that inversion still staring you in the face, that long, deep inversion still staring you in the face. Above 500, the appetite just doesn't seem to be there. So the question then becomes, well, what is the catalyst from excuse me. I can't edit on these things, so this is one live run all the way through. So if I have to sneeze or cough, well, you're going to get all of that. If I have to do it when I'm doing screens, I can just stop the screen and say, okay, well, I've only lost 2 minutes. Let's restart that screen. Mortgage rates up 1 basis point. The 10-year up 28 basis points over that period of time. Mortgages kind of holding firm. So there's lots of room for the spread to decrease as well. So I think that even if the 10-year rose even more, I think the mortgage rate can probably anchor around this level. Spread decreased 27 basis points, 249. OAS, just unchallenged by the whole environment. Nothing to see here. The IG back under 199 basis points. I was reading T-Mobile's 10K. Lots of debt with AT&T, Verizon, and T-Mobile. You want to see debt, go to these companies. And with buying back shares and increasing their debt, their leverage is massively increasing. When you start reading the section on the debt, they tell you straight up, we are basically immune from interest rates. Our debt is fixed rate, and the only exposure we have to higher rates is to the extent that we use our line of credit, which is at zero, and to the extent that we issue new fixed rate debt. But they are largely immune from interest rate increases. And I've been saying that for quite some time, given the sophistication of the financial markets today and all the tools for hedging and immunizing, and the sheer amount of issuance in 2020, 2021 when rates were really low. This is why we're kind of mixed, even though the two ETFs, home builders and construction, did fairly well. Arbor down another 4%. But it did have a nice Monday, but down 4%. They have earnings Thursday morning. Multifamily and office, and as far as commercial real estate, seem to be under the microscope as sources of problems for regional banks. Arbor has sort of made it through the 2 years. It's an audited statement this time, so it's important to look for adjustments. Does the auditor adjust anything from the previous quarters? Fourth quarter adjustments are never good. Usually a bad sign that some of the previous quarters might have been overstated. But they've been with the same auditor for a while. They've got a good relationship with the auditor. No fourth quarter adjustments. Everything is fine. I think Arbor, well, not just think, I know Arbor has to prove itself every single time. I don't know why they don't get the benefit of the doubt for anything. I don't know why they don't get any respect after years of proving themselves. Even through the interest rate hikes, I think they increased their dividend 3-4 times. Even while interest rates were going up, they must still sing for their supper. They must still prove it. So if Thursday comes, usually it's an underreaction. Every time they report, it's an underreaction on the day of reporting, and then the next day it goes. But it's always, I can always, thinking back, remember that They report good earnings, raise their dividend, and the stock would go, don't care, or it'd be down like 20 cents or something like that. It'd be, well, this is an opportunity to step in. If there were no fourth quarter adjustments, if the auditor is happy with all the transactions and how they've recorded the transactions, if earnings come in, well, they'll be lower than last year, of course, but if they come in at or above the expectation, then I probably would be selling puts or short. CPI revisions. This last line here, revisions to the headline figure were minimal, although December's monthly increase was marked down to 0.2 instead of 0.3. The 0.3 was, inflation is coming back. If it were 0.2, if it had been 0.2, the conversation would have been, it's going away. We're at the target. It's going away. There probably would have been more cuts priced in, not fewer. And I don't think the press conference would have went the same way. Because remember, he had CPI before they made their decision. So that's important to keep in mind, that there was a revision back down. I don't know that the market responded to it with a lot of excitement, but it was revised down. Had that original number come out, we would have had a different market. Canada Jobs Report. This is there's some conversation out there that because of this, the Bank of Canada is probably not going to cut rates as soon as the U.S. And when you combine the productivity argument, you could say the Bank of Canada might not cut rates sooner than the U.S. However, Canada is a country that needs rate cuts faster than the U.S. does because we are far more interest rate sensitive up here. So this is going to be interesting. I think Bank of Canada probably has 4 rate cuts in it this year. That by the end of the year will be 100 basis points lower. Mortgage rates have already started to come down in Canada. Not much, but they're coming down. So there is some anticipation. Employment change up 37,000. Multiply that by 9 if you want a good U.S. comparison. You're what, 340, 350 versus 355 for what the U.S. printed. So on par with the U.S. Unemployment rate came down, was expected to go up. Average hourly wage is 5.3%. Now in the U.S., that's not a big deal. In Canada, that is a big deal because our productivity sucks. But don't worry for you Canadians out there. The Liberals have a plan for dealing with productivity, a very liberal, progressive plan for dealing with it. Participation rate 65.3 from 65.5 has actually dropped. Got to talk about NVIDIA. They report earnings on February 21st when I said, what is the catalyst for getting this market higher? The AI story is sort of sitting on a shelf right now. Oh, it pops up every now and then, but it's not front and center. Not like the late 90s where .com. We had the AI frenzy last year where it was AI, everywhere you turned AI, and then it sort of went away. This is the AI stock story. This is what started it all last year, and it's going to report next Wednesday, the February 21st. Yeah, that would be next Wednesday. Let's have a look at it. It's 721. Now that was where it ended on Friday. A Q3 rev was 18 billion. A Q4 guidance was 20 billion because this report we're getting is Q4. The guidance was 20 billion with gross margins coming in at 75%. Those are big gross margins, 75%, 20 billion. Q3 EPS was 371. Forward EPS of 1950. How'd I get that? What I did was I looked at the growth rate from 18 billion to 20 billion quarter over quarter. And then I just projected the same growth rate out for the next 4 quarters to calculate the forward EPS, 1950. Based on the price now, that puts it at a 37 times forward PE. The market is almost at 21 times a forward PE. This is 37 times forward PE. However, if you use that growth rate quarter over quarter, that gives NVIDIA a PEG ratio less than 1. Hard to find PEG ratios that low. Which means if you ranked companies in terms of the strategy growth at a reason, look at what they've done in the last month. They've gone from 550 to 720. $170 increase, almost 33% increase in 1 month, and they're still sitting with a PEG ratio less than 1. That is an impressive story. However, it is a single story. It's a data center story. Their other data center revenue came in at some 14.5 billion of the 18.1 billion. So roughly 75% of the revenue is from data center. Is the AI story? Is data center story? If you have other other design firms, whether it be AMD or whatever, design their own GPU, it may not be as technologically advanced as NVIDIA's, but it may take a customer off the market where they start using their own GPUs instead of using NVIDIA's GPUs, figuring the performance is good enough without having to pay the big fat prices NVIDIA's charging. And we can all see what those prices are when you have gross margins of 75%. Current market cap, 1.78 trillion. 1.78 trillion. Price to sales of 22.5, given if you assume a Q4 run rate. In other words, take the 20 and multiply it by 4, say 80 billion run rate. Their price to sales is 22.5, but if you increase their revenue by the same growth rate, quarter over quarter for the next year, you get to 19 times forward sales. 22 times the Q4 current run rate sales, but 19 times forward sales, 37 times forward PE. Those numbers on their own sound very rich, but if we believe that growth rate can continue for a period of time and that they are so far advanced on the GPU that no one's going to catch up at this point, that perhaps they are like ASML in lithography, that they're so far advanced they virtually have a monopoly on lithography. Does NVIDIA virtually have a monopoly on GPUs? I'm not technologically inclined in chip design enough to be able to make a statement like that, but it is something you can write down as a potential hypothesis, an investment hypothesis. Does NVIDIA have a potential monopoly on this? The AI story, I think, does have a long tail. This is not just a fad that's going to end in 2 or 3 more quarters. Competition's going to show up in 2 or 3 more quarters. I'm pretty sure of that. But competition is showing up for ASML, but they are nowhere near the level of technology that ASML has. Could that be the case with GPUs? If that is the case for GPUs at a PEG ratio less than 1, this is a buy. This is growth at a reasonable price. Nosebleed territory if you just look at the multiples, 37 times and 19 times, even assuming the growth rate, 19 times sales. But if they're going to carve out a multi-year virtual monopoly space, they may still be cheap yet. Let's look at productivity, U.S. productivity. What I want you to pay attention to are these lines. The red line is labor productivity. Look at it. The blue line is output. There's your GDP. Look at them together and look at this flat line down here. That's hours worked. Now, when you look at the jobs report and you see certain statistics that are generally flat month over month over month, but you have big GDP reads, you got to have big productivity reads. And we did 3.2%, 3.2, output increased 3.7, 3.2 of that was productivity. And that means unit labor costs come in at 0.5%, way below the Fed's target. So they're looking at 4 to 4.5% unit. If you just look at the labor costs, we get the employment in labor costs that you get every quarter, thinking that is too high. Not if you have productivity. If you have productivity, your unit labor costs, that 0.5, that's what dictates inflation or deflation. So you have somebody working for you, you pay, we'll just say $1,000, and they're producing a certain amount of output. And you have to now pay them $1,200 to stick around. That's a 20% increase in labor, but if they then start producing 30% more output, your cost per unit have actually decreased. Your margins will increase even though you're paying more is because of the productivity. That is huge. Look at that, 0.5%, only 0.5 in the fourth quarter. In the third quarter, unit labor costs were negative. So if we're looking for where inflation is going to come, we look at unit labor costs. It's not there, but it is there in Canada. Have a look at Canada. Here's Canada's productivity since January of 2021. Look at it. We're on a slide down. Here is the US on a slide up. We're on a slide down. Canada is currently ranked 18th. GDP per hour worked at 42.5% of number one ranked Ireland. That means for every $100 of GDP, an Irish employee can produce, Canada does $42.50. Compared to the United States, Canadian productivity is diminished by 9% between 2000 and 2022, falling to roughly 72% of that of the U.S. Productivity sitting at about 72% of that of the U.S. And if you look at where the Canadian exchange rate is now, it is in the low 70s. If you are thinking about setting up a production facility and looking at the costs of things, productivity is one of those things that you look at. For some reason, Canadian productivity just has never been there, but you do have, it's either Canadian productivity is normal, but U.S. productivity is on fire for some reason, or there's something wrong with Canada. Lots of papers have been written on that. It goes way back. You can go back 40 years. I can remember reading papers called The Productivity Conundrum. We've had that problem for quite some time, but don't you worry, the Liberals do have a solution here, the progressive Liberals. 72% of that of the U.S. So given that our productivity is dropping, what do you think is happening to our unit labor costs? They are going up. That is inflationary. So that's where the thinking is on the Bank of Canada, is that, look, you've got high labor costs to begin with, and you have decreasing productivity, which is going to translate into high unit labor costs. So our inflation might be just a lot stickier than the US's, and if it is, the US will beat us in rate cuts. That means the Canadian dollar has room to appreciate. Okay, let's see what the Liberal government has. And I think you've probably picked up on a trend from this progressive movement we've had over the last 5, 6, 7 years, is that when there's a problem, you as a progressive don't have to fix it. You simply have to call other people out for not fixing it, and now you're part of the solution. You don't actually have to do it. And true to form, Freeland calls on Canadian businesses to tackle urgent productivity challenge. The finance minister urges companies to invest more at home. Well, that will do it. Don't provide tax incentives. Don't have some kind of policy, government policy, with incentives in place. Heck, that's old economist school incentives. Come on, let's urge them. All we have to do is call them out for not investing, and we've done our job. And if you think she's not spending money, well, you would be wrong. She's spending money, and wait till you see what she's spending on. Productivity boosting enhancements for sure. I don't think they know what productivity means. Freeland focused on where the spending is going and who is doing it. FDI is flowing into fields like EV batteries, for example. But we'd like to see more Canadian businesses investing more in Canada, citing a budget proposal to collaboratively get the country's pension funds to allocate more money domestically. Now, companies investing more is CapEx. Pension funds investing is a secondary market for equities. That's not CapEx. What does it matter who buys your stock if you're a publicly traded company? How's that going to change the level of CapEx that you perform? And if we assume that pension fund allocations are optimal with an international flavor to it, and you're urging them to invest more domestically, or a budget proposal to get the countries to allocate more domestically, what you're saying is we want our pensions to have less efficient portfolios. We want them to buy more shares of companies because that'll boost productivity. In the comments section, tell me how a higher volume secondary market is going to change the level of CapEx. I'm not seeing it myself. And in case you think they're done, they have more. Childcare and affordability measures are also productivity boosting investments, because if somebody's at home and they have children, they can't go to work. So if you give money to get their kids into daycare, taxpayers subsidized daycare, they can then go work and take a job, which will, hang on a second, I thought productivity was about getting more output per worker, not just getting more workers. Like, well, what's the point of that? Right? Do you get how that is a stupid statement? Productivity is about more output per worker, not about more workers. You can have more workers, but there's no guarantee that'll boost productivity. It might even decline productivity even more. There's no guarantee. So again, pushing on a string. But the last one will do it for sure. Another $99 million for rent support for low-income tenants. There you go. Now I know you're all saying, okay, well, there we go. There goes CapEx off the top. I mean, that's all companies were waiting for. It's like, oh, the rent's going to be paid. Oh, well, I'm going to invest. Oh, look out, productivity. Here we go. That was the big stumbling block. Do you ever get the idea that the liberals, at least these current liberals, are just making it up as they go? They really don't know what they're doing. They're just in over their head and they have no clue what they're doing. And at the same time, do you also get the idea that they're completely unaware that they're in over their heads and they don't know what they're doing, but that they feel that they're better than you? That's progressive liberals, all right. None of this is productivity. First of all, this is not productivity boosting. Productivity boosting is about more capital per employee. It's about getting more output out of the same employee. That if you have a company with 1,000 employees and you could do the same output with 900 employees, that's productivity enhancing. So Bell Canada did do that, and of course the Liberal government, and Trudeau especially, called them, what did he call them? Stupid? Bonehead? Dumb? Liberals. S&P over 500, another all-time high last week. And earnings did move in the right direction this time. 242 versus 241, and for SP Global, 240 versus 238. So again, not running away, not falling off a cliff, not skyrocketing, but this week at least moving in the right direction. Closing SPX 5,026. We now have a 20.8 multiple, forward multiple versus 20.6. And SPY at 501.20. The close on Friday was an all-time high. Still sits at an all-time high because Monday was negative. And as I do this, the futures are down some 20 points on S&P. Meanwhile, the Dow hit another all-time high, and the Nikkei index is threatening an all-time high that was set back in 1990. It only took 34 years to hit an all-time high in Japan. Shrinking population, and I think after the property crash, they lost like 90% of their market value. Big deflationary background in Japan. We gotta sort of put a pin in this threatening of all-time high for Japan, because the massive amount of money printing that has been done, that the 38,000 today that they hit in no way can compare to the 38,000 of 34 years ago. It can't. So you can always get the market higher by putting out more. Anyways, let's hope this one worked.